Good afternoon, everybody. Thank you for tuning in. My name is Tom Lee. I'm the Chief Investment Officer of Fundstrat Capital and the portfolio manager of the U.S. Large Cap Granny Shots ETF. It's been a very rough month, really, since February 18th. And in this monthly update, I'm going to change the format a little bit because instead of talking about Granny and the theme specifically, which we will cover, but that will be covered by Ken, I wanted to give you our thoughts on the current macro situation. So this is a chance for you to sort of let us lay out what we think's been ailing the market, why you should be not as terrible as things feel, you should not feel this is the end of the world. And also, I think most importantly, why I don't want anyone to actually be timing the market. So let me sort of walk you through our thoughts. And of course, I'll be answering some of your questions as well. So you should see on the screen, as you know, this is our monthly update for March. I do want to start with some particulars. The price of Granny ETF is 1868. The NAV is 1867, and total assets are 856 million. Now, markets started the year okay, but ever since February 18th, we've seen a steep slide in equity markets, and which I've highlighted here, and the S&P is below its 200-day moving average, which in a way is an important level. The reason the 200-day moving average matters is it represents the cumulative purchases by investors over that period of time. So breaking below the 200-day represents basically holders are sitting on losses. And so the question, of course, is, do people panic from here and liquidate? And so I want to walk you through why I think a lot of investors are going to hold the line actually pretty soon. Now, you might say this really hurts, and it's true, the market's down 9%, but I'm highlighting here that since the 2022 bear market low, and we know that was really due to inflation, there has been 6 instances where the markets have drawn down basically 8% or more. In fact, last year we had 2 drawdowns. One was 6% and one was 9%. So as terrible as things feel, it is pretty commonplace. I mean, it looks like it happens basically twice a year. So we're getting our first one now. And the reason it's happening is because a tariff war has started. And not only is this unsettling markets, but President Trump has, on record, said that, well, just be ready for some pain. It's really been a message that's come from several people in the White House that they're prepared to see the market take some pain here. And the reason it scares people is that it reminds them of what Fed Chair Powell said in August 2022 at Jackson Hole, which he said to fight inflation, there's going to be some pain. And as you know, that unleashed a lot of terror for investors. They're like, well, the Fed wants a recession. So naturally, markets have not only been hurt because of margin calls, because as stocks fall, this creates margin declines, margin calls, liquidations, forced liquidations, but it's also triggered investor panic. Because you know what, if someone says there's tariffs, they say, get me out of here. Okay, well, before you lose all hope, just keep in mind that the stock market decline has been far worse than the bond market decline. Now, they should really kind of move it together. Basically, corporate bonds and stocks are 2 sides of the same ledger. But as this tweet from RenMax shows, the stock market has had a huge reaction to tariffs over the past month, whereas the bond market has actually been very sanguine, meaning it's barely budged. And this is a divergence. And actually, in this chart, he's noting that those past divergences, which are marked as green arrows, have actually been tactical buying opportunities. So let's line up this sort of question, which is, what does it mean when equities are down, but corporate bonds are not? And here is my points I'd make. First, the stock market is reacting to uncertainty about the tariff wars, plus Doge and the fallout on the economy. And on top of that, the White House says there's no put. on the equity market. Well, that's not what people want to hear, but they do say there is an economic put. So they don't want the economy to fall so much as they're not watching what the stock market does. And I think there's a presumption the stock market is, the economy is resilient, and that's coming into question. The third point is, on the other hand, the bond market, I think, is holding up because it sees the Fed put coming into play. Now, the word put might be confusing, but the put means they are stepping in. So a White House put is, do they step in to try to support stocks if stocks fall? And the White House saying only if the economy really falls. But the bond market's saying, well, the Fed put might be coming into play because you know what? If inflation pressures are easing and now there's threats to the economy, the Fed will have to cut rates. So that's the difference, I think. And finally, here's the thing about magnitude. I think a correction, we're already down 9%. A correction more than 10% has to actually have two things. First of all, you're already assigning more than a 50% chance of a recession. It's closer to 66% because a down 15 is usually discounting a recession. So we're assuming a 66% probability. That's what the market's saying. And you have to assume there's no Fed put into play. I think that those seem too extreme to me. That's why I do think that there is a downside limit to how much stocks will fall from here, right? Because I'm not believing either is that true. So, we know the White House says there's no Trump put. Scott Bessent said this on Friday. But then the White House does say that there is a focus on business activity. So there is an economic put. By the way, that was put on display yesterday because Tesla fell 15%. On Monday, Tesla fell 15%, and the White House talked about, Donald Trump said he's buying a Tesla. That's what I would call a put on Tesla stock. The stock market performance since Trump took office is worse than Trump 1.0, as you can see here. So part of this is showing the intentional view that maybe there is no Trump put. But I do think this is what you have to focus on, that Germany and China are outperforming compared to Trump 1.0. In fact, let's look at these trade war countries. And this is really over the past month. Trump is launching a trade war with China, Mexico, Canada, and has threatened on April 2nd a huge war with Europe. This is the performance of those countries relative to the S&P in that period of time. And as you can see, each one of these nations has outperformed the S&P. So I'd say, what is that telling us? I think this is telling us the trade war is more at the moment being priced as a negotiating tactic. I know it's a strange thing to say, but otherwise, if there was truly a trade war, all those countries should be crumbling because they would all be going into recession. Now let's flip the coin around and look at the Fed put. This is the odds of the Fed making a cut in May. For most of the past year, or for most past few months, the market didn't think the Fed would cut in the first half. So that's why the odds were like around 10% or so. But you can see just in the last couple of days, it's gone to 50%. So now the bond market is seeing more than a 50% chance the Fed cuts in May. And I think as that gets to 100%, we know the Fed put is actually going to be exercised. And total number of Fed cuts is now up to 3.4. Remember, the Fed guidance is 2 cuts this year. So the bond market is now pricing 1.5 more cuts than the Fed is. So they are already pricing in a lot of Fed cuts. Now, directing our attention to the rest of the year, you might say, well, let's get through tariffs. Why should the stock market even do better? Look, there's a lot of reasons to be optimistic, okay? And I'm only giving you a handful of things here. But first of all, keep in mind gasoline is down and long-term interest rates are down. That actually matters to people in their pocket. The ISM has turned above 50, and small business optimism, which came out on Tuesday, continues to improve. Third, tax cuts and deregulation will be tailwinds later this year when they finally happen. Fourth, a tariff war is going to have an end date. I think that's what those, indices I just showed you kind of are saying. And finally, there's been a huge amount of de-risking. There's a lot of cash on the sidelines, degrossing by hedge funds, and massive retail selling. I mean, take a look at gasoline. It's down. This is oil, but it's the same as gasoline. You know, you're at more than 1 year lows for gasoline. And look at interest rates. They've gone from people talking about 5%, remember 6% interest rates, back down to 4% for the 10-year. That makes a difference to a lot of people. And the ISM has moved above 50. That's a big deal because it's been 26 months below 50. It's the longest ever stretch since 1948. And we know that the ISM is correlated to earnings growth. So as much as we know there's some risk because of tariffs, et cetera, business expansion activity is underway. And finally, just keep in mind, we did manage to have a positive January, okay? And that's happened 45 times since 1950, okay? So 45 out of 75 times. And of those 45 times, the chances of the full year being positive is 89%. So basically, only 4 years have been negative out of those 45. That's a huge, huge statistically favorable environment for stocks later this year. And as you can see here, that's why we do think stocks, you do want to buy the dip. Now, as for GRNY, Tireless Ken in the next section is going to talk about GRNY performance specifically, but you know, it's not like GRNY has been immune to this sell-off. But here over the past month, I've sorted the GRNY shots, worst declines to the least. Okay, and here are the 15 worst: Tesla, CrowdStrike, Arista, American Express, Intuitive Surgical, Goldman, GE Vernova, JP Morgan, Oracle, NVIDIA, Costco, Emerson Electric, S&P Global, Apple. These are, and Meta. These are down somewhere between 9 to 22%. Here's the question. Did the fundamentals of these companies collapse in the last month? No. Is their long-term outlook changing? These are structural winners. Each of these is a high-quality stock that has proven to be able to grow revenues and earnings for a sustained period of time. So I think they just got caught up in the sell-off. And the question you might have is, well, why don't I just go to cash? Well, here, I covered this in the video last week. You just want to keep in mind the rule of 10 best days, okay? Since 1928, the S&P's return has been 8% a year. But excluding the 10 best days, the market's return was minus 13, which means all of the gains, okay, of that 8% come from the 10 best days. And if you don't own the market, you're down 2,100 basis points per year. That's a huge mistake because that just shows, unless you know when you're going to get back in, you don't want to market time. And since 2015, the numbers still hold up. The market's return has been 12%, but excluding the 10 best days, it's minus 10. So basically, all of your gains come from the 10 best days, 2,200 basis points difference. And here you can see this on a chart as a time series. The S&P's return, annual return is shown here, 12% on average for the last 10 years, but excluding the 10 best days, you're down minus 10%. In fact, the last 2 years, if you miss the 10 best days, you'd only have 4% of your gains. So it's a reminder, just don't want to time the market. And just as a brief reminder, what our GRNY shots is, it's referring to an unconventional way to throw a free throw, underhanded. It's not as cool looking as an overhand free throw, but as you can see, Hall of Famer Rick Barry had a 90% win rate. We do a GRNY shot by focusing on long-term structural themes like millennial strategy, labor supply shortages and the rise of automation, energy and cybersecurity, as well as the fact that the Fed's easing financial conditions. We also look at what I'd call tactical shorter-term themes like style tilting every 3 months, seasonality trades, and then the fact that the PMIs are above 50. But to be a GRNY shot, it's not just like you're going to be in this theme. You do have to be one of the strongest stocks, but you have to appear in multiple themes. And so the stocks that are the most GRNY-like appear in multiple themes. And now I'm going to turn it over to Ken.
Thanks, Tom. Hello, everyone. Thanks so much for tuning our March GRNY webinar. My name is Ken Xuan, co-portfolio manager of Fundstrat GRNY Shots US Large Cap ETF, ticker GRNY. So in my part, I will go through the recent fund performance with you. And well, the market recently has been under tremendous selling pressure, especially with the rising recession fear. As Tom mentioned earlier, our fund is not immune under this macro environment. But I do hope my presentation today could give you a better sense of the recent fund performance change and also help you to understand how our fund works to really achieve the long-term fund objectives. Let me share my screen. Okay, first of all, the performance. This is as of the Friday, March 7th. So year to date, our fund is down by 6.44% in terms of net asset value and down 6.41% based on market price. During the same time frame, the S&P 500 total return index has been down by 1.66%. So relative speaking, our fund trailed the benchmark index by around 408 bips. Year to date, well, our fund performance is actually highly influenced by the overall market condition. And as you can see here, our fund has been keeping up with the overall market at the start of the January. And since the inauguration, really benefiting from the narrative that, no tariff from day one, our fund has really building up the initial outperformance. Well, of course, until the DeepSeek upheaval hit, but even with that, we were able to regain our outperformance all the way until really the second half of February when the market risk-off emerged. We also had our first fund rebalance on February 5th, as the vertical line showing here. And this is a closer look at our performance since the rebalance. Unfortunately, under the overall selling backdrop, our fund down more than 10% over the past month, while S&P 500 total return index also down 4.67%. The selling over the past 3 weeks has been so fierce that really brought down our fund performance from outperformance of over 200 bips into now underperform of over 400 bips year to date. And well, underperformance is not a welcome result, but more importantly, we want to know where this weakness is from and ultimately whether this will change our investment thesis. So here's the performance of our holdings. 5 stock has been up since the rebalance. They're all kind of relative defensive names here. The insurance company Progressive, and Abbott Lab, which is added in the last rebalance in February. And also Apple, well, it's not really a traditional defensive name, but compared to other Mag 7, so relatively defensive year. Of course, Garmin, have a good earnings, and the Bank of New York in the custodian and the fund services, so relatively more defensive than the other big banks. The laggard side, is primarily the prior momentum leaders, such as Tesla, Exxon Enterprise. Tesla has really been round-tripped since the election, and also the AI players like ANET, GRNY, Quanta Services, and also some stocks due to the bad earnings like CrowdStrike and Cadence. But again, I do echo that GRNY is not immune from the overall market condition. And as you can see from the sector performance and the broader tech, I mean, especially the Mag 7, really track down the overall market performance. And as you might know, that our fund actually has on all the 7 names of the Mag 7, so that also kind of help. I mean, not help, but impact our fund performance. And I think that's also one of the reasons why the most recent decline of the overall market feels so painful because, all the big decliner are really the name are widely held by the investors. But I think this is also kind of very, typical or classic risk of rotation. As you can see here, all the leaders are kind of defensive sectors, and all the lagging sector are really technical ones. And look at the style. As I mentioned earlier, the Mag 7 led the sell-off. So the cap-weighted S&P 500 has been underperforming the equal-weighted S&P 500. And of course, the defensive has been holding very well, while the technical get hit hard. And regarding the growth versus value, as the growth scare intensify, growth has been significantly underperforming the value, and especially, as you can see, the pure growth one. And other styles, the more defensive style, the low vol high div, has been up during the most recent market turmoil. But the prior leader, the momentum factor, which has been working pretty well over the past few years, has been down over 7%. The quality is down too, but down less than the overall market. And you might recall that in our most recent February rebalance, we actually shifting from our style recommendation from before was pure growth and the growth technical. Now we are removing the pure growth, then we're adding the growth quality. So that changing from pure growth to growth quality also kind of help us a little bit. As you can see, the pure growth actually is one of the worst performing style, even worse than momentum. And this is the return attribution matrix from the Bloomberg. As you can see, the underperformance of our sector allocation is really because of our underweight of the defensive sectors, which has been doing well during the market turmoil. But again, the majority of the underperformance is really from the stock selection part. I think the weakness of Mag 7 and also the other AI related name are the primary reason. As you can see, technology, comm services, discretionary basically, Amazon, Tesla, and also Exxon Enterprise has been the biggest lagger in terms of stock selection. Industrial, some of our industrial name are such as quantum services were under pressure, along with the other AI names. So the industrials is also one of the major lagger in terms of stock selection. Then let's take a look at the performance by themes. So recall that our GRNY ETF has 7 underlying themes, so 3 short-term and 4 long-term. So in order for stock included into the final GRNY portfolio, it has to be at least in 2 of the 7 themes. And for the analysis purposes, we just take the current GRNY ETF holdings and using their current theme membership, and we just equally weight it as of the last rebalance. So to calculate the return by theme, so it can help us to see which stock or even like which group of stocks actually contribute to this recent underperformance. So here's a short-term theme. So as you can see, unfortunately, all of the 3 short-term theme has been underperforming the S&P 500 index, especially the Stoutute, which heavily dragged down the GRNY performance compared to the other 2 short-term themes. Again, as you can see here, as you can see the time series, the short-term theme actually performed well until the sell-off started. And prior to the start of the sell-off, Stoutute, in fact, has been the best performing short-term theme here. And also the PMI recovery also outperforming the S&P 500 index here. From a sector perspective, I think one of the reasons has been too that all the three short-term theme has more exposure to the cyclical sectors. Hence, that's why they are all underperformed. The next is the long-term themes. Unfortunately, all our long-term themes are underperforming the S&P 500 index. Well, I think one of the reason is that all of these long-term theme are long duration and the relatively secular growth orientated. Energy cybersecurity, Tom mentioned in the prior um, weekly video, has really showed a similar pattern as the style to has been really been the best performing long-term theme until the market itself started. The global labor supplier, well, not a surprise, has a heavy technology exposure. Similarly, millennial has a strong growth exposure, and the Fed keep the fear of the Fed keep the rates higher for longer. Well, so in short, to summarize the reason for the GRNY's recent weak performance, first of all, I think uh, as I mentioned earlier, GRNY itself is not immune to the overall market sell-off backdrop. And secondly, GRNY's exposure to various factors also contribute to this underperformance. Like for example, the number one, the growth exposure from our statute, and also, as I mentioned, millennials. Number two, the technology exposure from our global labor supplier theme, and also the cybersecurity part of the energy and cybersecurity theme. And also third, the cyclical exposure from our short-term theme, especially from the statute and PMI recovery, and even for the long-term theme, the easing financial condition really contribute to the underperformance. And then I think the ultimate question to ask is whether this underperformance or this recent macro backdrop really change our investment thesis. To me, I think the answer is no. But admittedly that the recent sell is extremely painful, but I think the overall economy remain resilient. Sometimes I feel deja vu, like this is like Trump first term happens again. But I think compared now to like 2018, 2019, the market overall is under a much better shape. I remember back in 2018, 2019, there are a lot of similarity. There was a lot of uncertainty around the policy side, and also investor was also questioning, the sustainability of the growth. But I think that there are two major differences are back in 2018, the Fed was really on the hawkish mode. They're hiking rates, the financial conditions were tightening, but now I think Fed is largely dovish, and also given the current policy rate, there is still plenty of room for the Fed to cut. I mean, even if we're really slip into that kind of recession, which is not our base case, I think this is also what Tom has been referring to, the Fed put. Number two, I think I remember back in 2019, the earning has been really essentially flat, after the tax cut. But currently, even if we have a lot of uncertainty from the government side, that could impact the business planning or confidence. But I think the overall earning outlook has still be pretty optimistic. I mean, this could change, of course, but the current earning growth estimate, 10% for this year and 14% for 2026 are still way better than what we've seen back in 2019. So I understand it's hard to predict when the market will bottom, but I think the rule of 10 best days, which Tom actually mentioned in the last weekly video, we do think investors should hold on and stay on the target and even utilize the sell-off as a buying opportunity. So that will be my part. I'll get back to Carrie. Thank you.
Thank you, Ken. Hello, everyone, and thank you for joining us. I'm Carrie Presley, ETF product specialist for the Fundstrat Granny Shots ETF. I'd like to share a few updates on the ETF's trading activity and accessibility, as well as provide opportunities to connect with our team and stay informed. First up, the Granny Shots ETF has not been immune to recent market turbulence. While shares outstanding have remained stable, AUM has declined due to market movement. Taking a look at liquidity and volume as of March 7th, 2025, Granny has 45 million shares outstanding, a share price of $18.68, with a total market cap of $854 million. Over the past 3 months, Granny has averaged 1.25 million shares in daily trading volume, with the average bid-ask spread around 5 bips or less. As the Granny ETF expands to larger platforms, we are seeing an increase in trade size, which continues to be executed efficiently, thanks to both strong secondary market liquidity, but also the fund's implied liquidity. Currently, Granny's implied liquidity stands at 1.6 billion and 86 million shares. You'll see the holdings pictured sorted left to right. That's their 30-day average volume. And this highlights the inclusion of some of the most widely traded U.S. large-cap stocks. For those looking to invest, the How to Buy section on GrannyShots.com provides a list of platforms where the ETF is available. Granny is also being added to new platforms, further improving accessibility for advisors. Again, we appreciate the support of advisors familiar with the Fundstrat research who have been instrumental in the approval process. To stay informed on fund updates, especially during periods of volatility and uncertainty, visit GrannyShots.com. Under the Fund Updates section, you'll find weekly update videos from Tom Lee on the macro landscape and its implications for the ETF, along with replays of all past webinars. Also, consider subscribing to our YouTube channel. You'll get notified as soon as new videos drop. Personally, this is my favorite way to stay up to date and watch those updates. Lastly, a few upcoming events. Tom Lee will be speaking at Future Proof Citywide in Miami on Monday, March 17th, followed by a meet and greet at the title booth. We've also just confirmed our attendance at the Exchange Conference in Las Vegas, March 23rd through 25th. If you're attending, reach out. We would love to connect. And if you're an advisor interested in a local meetup, send us an email and we'll make sure you receive an invite. Now that we've covered fund updates, performance, let's dive into your questions. Tom, the first question is for you. If tariffs remain in place, which long-term themes could face heightened risks or present new opportunities?
Thanks for the question. If the tariffs remain in place, which they could only remain in place if they actually become law. So keep in mind that tariffs really need a change in law to actually be permanent changes. And I just want to point out a couple things. First, as I pointed out, if you look at the countries facing tariff risks, China, Europe, Canada, and Mexico, since February 18th, 4 of those 4 indices are outperforming the S&P. So the market is not assuming these tariffs are permanent. But if they are, really the things that we highlight structurally still remain in place. If we're going to have more onshoring, because that'll be a consequence of tariffs, well, that's going to increase the need for energy and cybersecurity. So it'll strengthen that theme. There is going to be a labor shortage and productivity part because we're going to be producing more things in the U.S. And so that strengthens themes. But we might, of course, if this becomes law, perhaps modify some themes to look at long-term winners because of onshoring. Thank you for the question.
Next question, Ken, this one's for you. Some stocks in the Granny ETF align with multiple themes. Google and Meta, for example, match 5 of the 7 total themes. Given that, why doesn't the fund overweight those stocks?
Thanks for the great question. Actually, believe it or not, we actually thought about this when we first started this as a research product. However, we found that if we're using this methodology, our portfolio will basically shift to a long-term, like a secular growth portfolio with heavy overweight on the Mag 7 or FAN Plus. And that's kind of against our original goal of this strategy. Again, I mentioned this many times. To me, I think the most beautiful part of GRNY ETF is that it's this combination of short-term and the long-term themes. In other words, we want to hold those stocks that benefit from the long-term macro tailwinds, while rotate in and out the name that in the short-term theme that could capture the market short-term changes. And because of that, we also want to give the name from the short-term theme the equal exposure, or even you can call it equal opportunity. That's why we actually decide to have our portfolio equally weighted as of each year balance. But it's a great question. Thanks for asking this great question.
Tom, this question is for you. What key data points are you monitoring to assess the easing financial conditions theme? Are there specific macroeconomic shifts, such as inflation trends, Fed policy changes, credit market signals, or policy shifts from the current administration that would prompt you to adjust this outlook?
Okay. Well, thanks for the question. Easing financial conditions, it's really a two-part question. One is, what are some ways to measure easing financial conditions, and what does it actually mean? Let me just start with the first question, how to measure it. You really want to look at a composite of what defines easing financial conditions. And easing financial conditions really means that cost of money is lower. So you want to look at things like spread, and accessing money is easier. So you want to look at measures of liquidity, and you also want to look at things that are creating wealth. So like rising stock prices, etc. Bloomberg actually has a financial conditions index. Several of the regional banks of the Fed publish their own financial conditions index, and every brokerage firm does. So there's many ways to actually measure easing financial conditions. But the question you might ask is, what does it really mean? Well, easing financial conditions means, is it easy for money to flow around the economy? And when the Fed is easing, then they're easing financial conditions. And when markets go up and financings are happening, that's easing financial conditions. Thanks for the question.
Next question is from a Morgan Stanley advisor asking, I'm unable to access the GRNY ETF. Any updates? So we have addressed similar questions like this in the past, but this is a great reminder that each platform has its own approval process. Advisor demand is critical. If you're interested in seeing the Fundstrat GRNY ETF on your platform, communicating that to your home office can help expedite the process. And we're actively working on expanding availability and truly appreciate the advisors that are assisting in the approval process. All right, next question. This is for Tom. Tom, in your latest weekly update, you highlighted immigration as a key factor in millennial growth. The U.S. Border Patrol reported 8,300 migrant arrests at the southern border in February, the lowest monthly level on record since enforcement statistics began in 2000. At what level of immigration control would you reconsider your millennial growth thesis?
This is a great question. At the moment, investors are probably doing what I call extremism, because they're seeing the interceptions at the border drop to zero, and even deportations happen. And they're assuming that means there's no immigration in the U.S. Since 1950, there have been roughly 750,000 naturalized citizens in the U.S. that has counted towards population growth. So roughly about a third or a quarter of all population growth in the U.S. has come from immigration. And the question is this going to go to zero because of the new policies? I would say that's not really what's going to happen, or even the explicit policy of the new administration. As you know, the administration just wants to attract the right type of immigrants. So they are selling a gold card which for a certain price at the moment, it's going to be 5 million, you can actually become a naturalized citizen. One, that's attracting a high quality income profile, and that's a pathway to the US. And of course, especially given Elon Musk and, many tech folks and economic oriented folks in the administration, it's not lost on the administration that qualified skilled labor is important. In fact, President Trump himself talked about how they don't want American universities to be graduating foreign students and then not grant them some sort of visa status to stay instead of them going back to their own country. So I wouldn't want to misread what's happening with immigration as saying that there won't be immigrants, but rather I think it's just a change in the composition. Thanks for your question.
Okay, and that concludes our Q&A. Thank you, Tom and Ken, and thank you all for taking time to join us today. If you have questions for our team or you would like to set up a meeting with the Fundstrat Capital team, email us at inquiry@fundstratcapital.com or use the Contact Us feature on the website. Before we wrap, a quick reminder to sign up for email updates at grannyshots.com and make sure to follow Fundstrat Capital on X, LinkedIn, and YouTube. So the market is certainly giving us some March madness. Just a reminder to stay on target, hang in there, and we hope that you all have a great afternoon. Thank you.